Index funds. Index funds offer market returns at lower cost, while active mutual funds aim for higher returns through the skilled management that often comes at a higher price. When deciding between index or actively managed mutual fund investing, investors should consider cost, time horizon, and risk appetite. Index funds are mutual funds that track the performance of benchmarks like the S&P 500 by mimicking their makeup. These unmanaged investments, observed as being an unimaginative way to invest, are behind a primarily unnoticed change in U.S. equity markets, attracting an ever-growing number of investors as passive index funds tracking market benchmarks accounted for just 21% of U.S. equity fund markets in 2012. Last year, unmanaged index funds had grown to about half of all U.S. fund assets. The giant adjustment in the increase of passive funds has come as they often outperform their actively managed peers. According to the widely followed S&P indices versus active scorecards, about 9 out of 10 actively managed funds didn't match the returns of the S&P 500 benchmarks in the past 15 years. An index fund is a portfolio of equity or debt created to mimic the makeup and results of a financial market index. Mutual and exchange-traded funds have many different varieties of low-cost index funds focused on some part of the market or the whole of it. Due to the lack of interference, they have lower expenses and fees than actively managed funds. Index funds involve passive investing using a long-term strategy without actively picking securities or timing the market.